What's up, guys? Welcome back to another episode of Behind the Facade. I'm your host, Gavin J. Gallagher, and on this podcast, I explore the mental and emotional game often playing out subconsciously, both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Guys, real quick before we begin, I have created a brand new accelerator program. It kicks off in mid-May and has an in-person welcome event starting on the 1st of June. I've put a ton of work into building this course, and it's important to point out that this is not a novice level program. It's for people who own property and want to be involved in the property business. It's aimed at time-poor business owners, corporate executives and professionals who might harbour ambitions to build their own property portfolio with the potential to fully replace their salary. Now, you may not want to leave your job, or you may not want to give it up or anything like that, but I think you will see the value of having options beyond selling your time for money. If this sounds of interest, please click the link below to book a call with me to discuss whether or not you're a right fit for the program. I do look forward to meeting you in June if you are, and working closely with you on this exciting journey. Now, back to the show. What's up, guys? Welcome back to another episode, and today I am thrilled to be able to bring my conversation with Brendan Allen. Now, Brendan is a leading expert in Irish property tax. He has over 30 years of experience as a chartered tax advisor, a chartered accountant, and a certified public accountant. Now, Brendan, as you'll learn from this conversation, has an absolute wealth of knowledge in navigating the intricate world of property taxation, and it is quite complicated, I have to say, and you'll learn about that as we go through it. Brendan's career spans lecturing of public bodies. He works with private groups, a little bit like my mastermind, and he also runs his very own tax practice. He brings a unique perspective, combining practical experience and a deep expertise in tax laws affecting landlords and property investors. In this episode, we're going to dive really deep into some of the sort of complexities of Irish tax. In particular, I went into very briefly, but just we covered, VAT on property transactions, some of the issues, the benefits and the challenges of using limited companies for your tax, for your property investments. And there's various, positives and negatives to doing that. We also talk about various tax reliefs and allowances that are available to landlords and business owners. And it is possible to turn your property portfolio into a business so that you can actually avail of retirement relief and stuff. And I think that's going to be very interesting for some of you that are doing this. Brendan also shares some invaluable advice for non-resident landlords and young property investors, helping them to avoid some of the common mistakes that he has seen, and make informed decisions to make sure that they get this right. Like, one of the things about property is that it can be a great wealth creator, but can also destroy your wealth if you get it wrong. And so you do need to be careful of that. So whether you're an experienced investor or just starting out in the property market, this episode, I feel, is packed with insights and practical tips that are going to help you navigate the ever-evolving landscape of property tax. So guys, without further ado, my conversation with Brendan Allen. Brendan Allen, welcome to the podcast.
Thank you. It's great to meet up with you at long last and to learn some insights from the master, such as yourself.
Don't even go there. Yeah. So, Brendan, I was just, I'm delighted to have you on here, and we've been threatening to do this for a while. And I've had a lot of people in my mastermind have been asking me to get you on the podcast, which is great.
It's good to hear.
For anyone who is listening in and hasn't heard of Brendan Allen, why don't you give us a quick intro to yourself, just to kind of...
Okay. I'm a chartered tax advisor, chartered accountant, certified public accountant, and I love talking about tax. It is a great opportunity for me to speak without my wife interrupting me, which is quite a feat. And I'm I'm in practice for 30 plus years, lecturing for over 20 years. So there you go.
Where do you lecture?
I lecture to the various professional bodies and then to other groups such as yourself.
Okay, gotcha.
And I've done some podcasts and various other things as well, which I enjoy doing. The thing is this, taxation is not straightforward and you need to know the ins and outs. And while it's nice for me to speak with yourself, but it's important that people talk to their accountant, to their somebody who understands the issues. One of the concerns I have, I am a member of a number of Facebook groups, and I would ask your members of your various groups, do not take advice from Facebook. If you're investing 200,000 plus or whatever, maybe for a property with somebody who thinks, or, oh, I think it is, that is not good enough. Being in property, you've got to reduce the risks. And that's the name of the game.
Yeah.
So Facebook is not an answer to talking to your accountant.
Yeah, no, I totally agree. And like a little bit of knowledge is a dangerous thing because it gives you a sense of confidence that may be misplaced.
Yes.
And I've had that before, especially in the area of VAT around property, because that's an area.
Yes. Yeah, well, I love that, to be quite honest with you. And the reason why I love it is because it keeps me in business. And I regularly thank the Minister for Finance for keeping it as confusing and as difficult as it is. And I get quite a number of referrals from solicitors who are in a situation where one of their clients is buying a property and what's the VAT thing, and you've got to do your pre-contract inquiries. So it can get very complex, particularly if it's a mixed development, you know.
Yeah, well, I know I've had a couple of run-ins with the tax side of things before, and it's very confusing because the length of the lease and all of that kind of stuff, and depending on the use of in fact, I think it's best that we don't even go there because it's so confusing that it'll only make matters worse for a lot of people, other than to say, if you're buying a property and there's any question of there being potentially a VAT exposure, then go straight to your accountant and make sure that the accountant himself actually knows enough about it.
Yeah, indeed.
Because the accountants often need to go to a specialist themselves.
Exactly. Yeah, I'd agree with you there. One thing that comes up quite regularly for landlords is where they would buy a property and it's of mixed use. Say it's a commercial downstairs and upstairs they're doing it's residential. So what they're trying to do is convert the whole lot to residential. Now, the issue there is it's materially altered use. VAT applies, particularly if you're selling the property. So you can get yourself into a whole pile of mess without understanding what you're at. So talk to your accountant or your tax advisor, because that comes up time and time again.
Yeah.
Another thing, just while we're talking about what comes up, guys lending monies into the company and then they want to charge interest on the director's loan. Guys, don't do that. The way it works is the revenue will look at the lower of 13% of whatever your share capital is. And it's that or 13% of whatever the total loans are. So you end up with most of the interest not that you're charging your company, not being allowable. You then have a dividend and you have a whole pile of mess. So basically, do not charge interest on a loan that you put into a company. It really is no advantage to you.
There's so many little areas that people would just make assumptions that this is a good idea commercially speaking, but they just don't know enough about it, and that's the danger. One of the questions that I had for you, well, before we get into questions, actually, I thought maybe just a little bit of, where are you where are you from, and like tell us about your kind of journey into the property industry.
Yeah, where I'm from originally is in Walkinstown in Dublin 12. I lived there when it was the countryside. And I can remember, you know, being so far away from the city centre that, you know, you'd nearly want to bring a flask and sandwiches to get out to Walkinstown. So we lived there, and then we moved on, and I lived in Leixlip then for quite a while. I was in practice for 16 years in the UK.
Oh, wow.
Then I married and came back to Ireland, and I've been in Ireland for 20 plus years. So my journey has been, we bought a number of properties, both in England and in Ireland. We've disposed of the property we had in the properties we had in the UK, which we're glad to get out of that market. And we're property here in Ireland. And the fact that you're an accountant doesn't mean you don't run into problems. Like the rest of the landlords, we did run into some serious issues with loans and loan to values and so forth. But with time and patience and just carefully working on things, it worked out for us in the end. But it takes quite a while to recover from the gross overcharging by some of the finance houses, and particularly when they sell on your loan then to some of the other.
Yeah.
That is crazy, because what tends to happen is they bump up the interest rate, they end up with a default or a bankrupt, and then they're not recovering their money, you know?
Yeah, I know.
So
that's a whole separate podcast.
Pardon?
That's a whole separate podcast.
It surely is. So yeah, we won't go there. But it astonishes me at the naivety of it, of some of the decisions taken by the Irish banks.
Yeah.
But anyway.
Well, I mean, if you go back to 2008, obviously that's the whole thing is they went from one extreme to the other, where literally giving out the money, they didn't even pay any attention to whether or not you had the ability to repay and things like that. And then compared to today, where it's, you know, everything, like they're going through the kitchen sink. You might be buying a rental property, and so the rental income is the thing that is going to be generating the return to pay the loan. And yet they'll go into checking your salary income and all of this kind of stuff. And it seems like that nobody's paying any attention to the actual outcome that's going on.
Yeah, but, well, in some ways that's better in a sense. You know, have you got the capacity to repay it? And you know, obviously it's a question of balance of which is the right way to go on it, you know?
Yeah. Yeah, I guess. Let's get into some specific cases. I mean, the evolution of the tax. I remember back in 2005, 2006, we had 20% capital gains tax. And so at the time, I can remember I was flying high, buying and selling and trading and flipping and doing all this kind of stuff. And the advice at the time was very much do it in your personal name, because then when you sell the property, you just pay your 20% and then all of the profits sitting in your pockets. Whereas if you did it through a company, the company paid capital gains tax. Then in order to extract the money from the company, you had to pay us an additional tax and all that. Nowadays, obviously, we've been through 2008. People realize the value of a limited liability company for protection and exposure and all that. However, that introduces an element of taxation that I don't think everyone is clear on. So it would be great if you could just maybe give us a little rundown on the benefits.
Yeah, indeed. The operating through a company, you've got to ask yourself, what are you trying to do? Okay. If you're trying to build wealth, a limited company is a good approach. If you're looking for a lot of income, the combination of limited company and personal holdings may be better for you. Because what happens with a limited company, you end up with a situation where the tax rate is currently at 25%. Okay? There is a possibility then of what's called a close company surcharge on the profits remaining after tax are taxed at 20% if you don't do anything within 18 months of the financial year end. There are ways around that, which we'll get into later on in our chat. So the issue then is, it is worthwhile in a company because you have less tax leakage. And you may find a lot of lenders actually prefer a limited company. And the reason for that is there's less tax leakage from the project. So if you think about the situation, if you're, say, a 52% taxpayer, what you end up with is, if you've got debt of 400,000 and you need to pay that back, think of what you've got to get. You've got to get 800,000. In
income,
right?
Yeah.
Whereas at the lower rate, you need to generate 533,000 to clear off that debt. So in that sense, it's a lot better. But I do take your point. If you want to sell that individual property, what ends up is the company has a CGT liability because it's a separate legal entity. Because it's a separate legal entity, it's got its own tax liability. Now, there are one or two ways that you may want to mitigate that. Number one would be, what if you've got a collection of properties and you decide, well, this one I want to sell for whatever reason? What you can do is either move that property into a separate company. So you've got that one property standing in that particular company. So you have a choice. What do you do then? You can then just sell the shares in that company if you've got a willing buyer to do that.
Yeah.
If you don't have a willing buyer, you've got a problem, because it is very difficult. But it's only the second layer of tax will only hit you if you want to take that money out.
Out of
the potential 33%. But the tax return is a bit complicated in there, because you effectively pay that rate, although it's calculated in a slightly different way for companies. So there's no real way of getting around it other than pushing it out to a separate company and selling that company shares. Some people do that, others don't. But it's perhaps a good way of looking at it. However, you've got to ask yourself then, what are we doing? Are we renting, or are we operating under a license? So, for example, there is a major trend now to go for HMOs.
Yes.
Right? So if you think of a HMO, so you're effectively letting out on a room-by-room basis. Now, there are issues possibly with VAT, because once you get over the VAT threshold, what you're looking at there is this. The VAT threshold is 40,000. If your income is over that amount, you are VATable at 13.5%, and it's actually built into your figure.
Yeah.
Now, however, one of the good things about us doing this room-by-room letting and HMO business is that it is deemed to be a trade. So if it's a trade, okay, now we're talking high-level stuff here,
yes,
so you don't need to talk to your accountant or tax advisor. But basically, what you're looking at here then is a trade, 12.5% tax. Isn't that nice? But even better, right? Say you're getting to a stage where you've had enough of this HMO stuff and you decide, well, I've had enough. Guess what's available to you? Depending on your age, you can get retirement relief because it's a trade. And if you carefully set it up, you can actually get the tax relief on the property as well for retirement relief. Okay? So the maximum there is 750,000 tax-free. Nothing wrong with that. And if you're careful enough and you have your spouse involved, it could be 750 by 2 if you set yourself up properly. The other bit of magic that you could look at is what's called entrepreneurial relief. And that basically means is if you've got capital gains tax of up to 1 million, that is taxed at 10%. So you need to set yourself up if you're going for these particular reliefs. So it could be well worthwhile. The entrepreneurial relief is quite nice in that you must hold the property for 3 years, own more than 5% of the shares, and you can keep doing it till you reach your million. With the retirement relief, you must be at retirement age, and you must, comply with those other regulations. And the amazing thing, though, about retirement relief, it's really misnamed because you don't actually have to retire. You just need to dispose of your shares, if you like. And that's it. But they're true, very, very valuable reliefs as a result of being in a situation where you can get yourself classified as a trading entity.
Yeah.
Now, the VAT is an issue. Again, who you're renting to or who you're letting the property to. So, for example, letting to students is outside the VAT rate or is outside the scope of VAT, which, again, if you're careful, if you set it up properly, no VAT.
I think there's sorry, go ahead, Brendan.
Yeah, then if the other issue is, if you're also then looking at a situation where you're providing emergency accommodation, now this typically would arise where the government has engaged you to provide accommodation. Okay,
so would this be refugee status kind of?
Yeah, a lot of that, but the contract has got to be with a local authority, a government agency. Again, that's outside the scope of VAT, right? However, that's for the accommodation only. But if you're also supplying food and various other things, that element of it could well be within the VAT net if you're supplying food. So there's tiny little nuances there that can either make or break your operation. But I would warn anybody listening to us here, do not fall foul of the VAT regulations. If you fall foul of the VAT regulations, it will really, really hurt you. Because basically, if you're letting ordinary property, residential style, rooms and so forth, or a B&B or a hotel, you're looking at 13.5%. Or if you're doing commercial, you're looking at 23%. So it quickly turns into an absolute major nightmare.
Yeah.
Okay.
Because they'll go back after the unpaid.
They will go back after it, yeah. And typically the revenue can go back 4 years, as we all can do as taxpayers. However, if the revenue contend that you've filed incorrect returns, okay, they can go back as far as they like.
Wow.
Now, you need to have good powers of negotiation to work your way through that. And the penalties can be enormous. I don't know if any of our members here look at the defaulters lists that are published every quarter. I look at those myself because I'm saying, oh my gosh, another landlord, what has he done wrong? But the issue there is most of the, not always, a significant amount of the repayment is indeed interest and penalties.
Yeah, you might have only made a mistake on a certain amount, but you end up getting a double whack for the
absolutely. I mean, submitting an incorrect VAT return, the revenue can charge you 4,000 per VAT return.
Wow.
If they so wish. So, they have absolute sledgehammers to go after taxpayers who are delinquent in dealing with their affairs. So it's more and more, you need to keep yourself, de-risk yourself is the name of the game, both from lenders, but also from the inspector of taxes. Bear in mind, if you now look, the Revenue's most recent report what they've published is the number of what they call interventions. And basically that means they arrive at your door either by agreement or otherwise. Generally, it's by agreement. The number of interventions have actually dropped. But guess what's happened? The yield has gone up.
Yeah.
What does that mean? That means to you, me, and the others listening, that they have targeted delinquent taxpayers, and they have amazing means of doing it. They have a system called REAP, which is, I think it's revenue evaluation and appraisal profiling. And a story one of the tax inspectors I dealt with told me, yeah, this guy called into him. They had agreed a repayment schedule. Everything was going wonderfully. Guy was repaying. And after about a year and a half or so, the gentleman, the taxpayer, came in along with his accountant and said, by the way, look, we've got to relook at this. Paying you $2,000 a month, I just can't continue to do it. It's just not possible. And the guy in the Collector General said, look, we'll do our best to help you. So yeah, we did. Okay. So what they did is they ran this gentleman's name through the REAP system. What it showed was that he'd just purchased a new car for over 100,000.
My God.
And he couldn't meet the repayments of the car and revenue repayments. So just think about what happens. The revenue, if you buy a house, tax a car, if you're in social welfare, if you've got a health, health card, anything, any interaction with the state, the revenue know about it. Now, the revenue's problem basically is to know what they know, because they've just so much information coming into them. For them to control that sort of level of information, they're getting better and they're getting smarter all of the time. So it is a huge issue for us as taxpayers to make sure you are not going to get away with it. And look, guys, the only real way of saving money in tax is to die, right? And that's the only solution.
Yeah,
now,
death and taxes.
Yeah, exactly. And that does give you a certain amount of relief from capital gains tax. But even if you owe money on your death, they will come after your estate.
Yeah.
Now, I'm not trying to spell fear and loathing throughout the country, but crikey, just get it right, or if you've got an issue, make sure you address it as soon as possible. Now, somebody like with your experience, Gavin, I mean, you're helping people through their property journey. And I know part of the leg of what people need to do is understand the tax implications of what they're doing. And trying to pull tricks on revenue really is very, very difficult. I got really scared when I saw the number of interventions dropping, but the yield from those shot up, So it means
that the sledgehammer is much bigger now.
Yeah, but it's also more targeted. So, that they're really identifying people with who are not playing the game. And I think we all owe it as landlords to play the game in the sense, pay our taxes and be as compliant as we can. Look, we're all in the business of trying to make money and trying to make the system work. I mean, one of my phrases typically is, landlords are part of the solution, but we're only part of the solution to the housing crisis if we are compliant. And trying to hide, I'll do this one for cash and something else. Guys, no, Now, I can understand if one of your properties and there's a leak at 12 o'clock at night and you ring a plumber to
he might want
come out, what are you going to do, right?
So,
well, what I do is, when that does happen, obviously you pay cash and then you put the guy's name down your register and hope the revenue don't ask you about it and claim the expense. But look, it is, you're faced with absolute
it's a slippery slope, in other words.
A slippery slope. But if you continue to do that on an ongoing basis, guys, you're not going to...
you'll get caught eventually.
You get caught. the other issue, what I find with a lot of landlords, what they don't understand is capital allowances.
Yes.
And basically, what capital allowances are is you get tax relief on any of the furniture and fittings that are inside your property. So, for example, a kitchen, wardrobes, carpets, there's a whole range of stuff that you can get a tax relief on. Now, it's 12.5% per year, but it's better than a kick in the pants. And typically, if you think the fitting out of, say, a 3-bedroom house, you're looking at about 16,000 or more even,
Yeah.
So,
which you can reclaim, yeah.
Yeah. The big thing that is trying to identify, and this is the area where accountants live, is what is a repair and what is capital expenditure. Yeah. And we ponder that sort of stuff on an ongoing basis. So there are a number of guys out there, some of whom you may already know, who specialize in capital allowances. And if you've got a significant portfolio,
it's worth talking to them, yeah.
Talk to somebody, and I can pass on details of the guy I use. But it is really worthwhile getting that. One other new thing that has happened since January of 23, and that's important for landlords to understand, particularly landlords where you're operating through a limited company. So you're operating through a limited company, you're facing your 25% tax rate. Then you decide, well, I need to take a salary out of the company, take a nominal salary. But guess what? Since the change from January 23, you can now claim an employer's PRSI contribution against rental income.
Okay.
So just ponder that. So what does that mean to you? It means that you could almost eliminate your corporation tax charge, and you have the benefit of the tax relief on your pension. Now, a lot of guys say, oh, my pension is tied up, and yes, it is. Look, guys, you've got a choice.
Yeah.
What do you want to do? Do you want to give more money to the revenue, or do you want to take the benefit of that at a later stage in your life? Because when you get to the retirement age, I think it's 50 or 55, I don't give pension advice if tax. But what happens is you can take 25% of your pension out.
Tax-free, yeah.
Up to a limit of 2 million. But what if you and your spouse own these things jointly?
That's 2 million.
2 million each, So I've got a client who is a director of a PLC, and his pension is 2 million. His wife's isn't. So guess what we're doing? She's operating that PRSA thing, and there's a few other little tricks around PRSAs. Now, it's got to be the employer taking it out, okay? Yes. Yeah. It cannot work for a sole trader taking out a policy on himself, but it can work for a director of a company for himself or the employees. So you can end up with very little tax to pay to the benefit of yourself. It's a long-term benefit. Do you want to do that, or do you want to pay the tax?
Yeah, I think I've spoken with Christina Buckley before, and
I know Christina.
Yeah, Christina really summed up a lot of the benefits of it, and she had done it in her personal case.
Yeah, she did.
It was very interesting to see how you can actually make it work for you, and effectively, you can pay down your debt so much quicker as well, because there's no leakage at all in your income.
Yeah, exactly. And if you can just think about it, if there's sufficient capabilities in your limited company, you could build up a sufficient pot inside in your pension fund for the pension fund to buy property in its own right.
Yeah.
No income tax, no capital gains tax. You've
Yeah,
only tax when the money comes out.
yeah, I've
But you've
dealt with a
got to
few
have
people.
sufficient funding in there. Now, the pension fund itself can borrow. However, if the borrowing, it's capital and interest, it's not interest only.
Right,
And you
okay.
can't be flipping inside, you can't be trading in your pension scheme. And you need various other advisors to advise you around that, not
Trustees
me.
and yeah, you need
Yeah,
trustees and administrators and things like that.
all that sort of wonderful stuff. But again, if there's sufficient inside in your pension scheme, it's something that's well worth looking at. And I must say, I like that idea myself.
Yeah, the pension, I mean, I've seen the benefits of it myself because I set up my own administrated, self-administered pension fund a couple of years ago. So there's a
Yeah,
lot of benefits. One thing I wanted to go back on there, Brendan,
mm,
that you mentioned the retirement relief on if you had established a HMO portfolio, we'll say,
yeah,
and built it up. A lot of people, when they reach that age, they'd be thinking that they might like to pass the portfolio on to the next generation,
yeah.
so their kids or something. Would you be able to avail of the reliefs if you were to do that? If you were to sell it in essence to your children?
Yeah, that relief is available. Now we've got to be trading. Okay, so we discussed about that earlier on.
Yeah, it's not
Go back
rental
and
income;
listen.
it's trading. Yeah.
It can't be straightforward rental income. Now, so the conditions for retirement relief are: if you've got an asset, it must have been used for the business for the last 10 years. Okay, you must have worked um, in the business for a substantial part of your time per week. Okay. And that's basically, again, for the 10-year period. There is derivations if you're ill, it can be reduced to 5 years. But typically, if you've owned an asset that is being used for the trade, you can get the benefit of retirement relief. This relief, however, for the property as well as the trade, only applies to retirement relief. It does not apply to entrepreneurial relief. And you want to be just very careful. But what if we did this? We were smart enough, we're looking up to it, we're thinking, why don't we move the trade either to a separate company or move the property to a separate company or do something like that, and then claim our entrepreneurial relief on the trade? Now,
Right.
it's high level stuff. You'd want to have an agreement between you personally, if you own the property, and the the trading company. But I mean, there are sort of avenues like that, and it's a question of sort of thinking and planning ahead. If you're 65 or that sort of, it's going to be a very tight timetable depending
Yes.
on what you're doing. If you're at the beginning of your journey, setting yourself up early in understanding where you're going and understanding what your objectives are. Where do you want to get to and when? It's well worthwhile.
Having some
Property
clarity.
can be a great opportunity, but it isn't always that easy. I know being a landlord, oh God Almighty, it can be difficult sometimes.
I'm
Depending
hearing a
on
lot of complaints about it these days. All right, yeah, a lot of people deciding to leave the market because of the perception, anyway, that the tax is particularly high. And
yeah. But look, to be honest with you, I think people misunderstand what happens here. If you've got additional income on top of your PAYE income, it is going to be taxed at
at a
your
higher
highest
rate,
rate. And
yeah,
that's just it. If it happens to be property, that's the way it is. If it happens to be income from shares, if it happens to be a
some
second
other,
job, it's all going to be taxed. So you've got to understand all of your income is added together. And if you think of a tree, you get different branches bringing in different levels of income. And they're all into the one trunk. It's the trunk itself that
that
is
gets
taxed at
taxed.
the highest rate. So, in my opinion, tax is an issue. Nobody wants to pay it. We've discussed ways of going around it. But what what do you want to do? If you're living in Ireland, you are going to have a tax situation. There isn't any easy way around. There's ways of mitigating it, but you're not going to avoid tax. It's as
altogether, yeah,
straightforward as that. It ain't easy. And look at some of the strategies we discussed. In fact, I'll send you on, Gavin, some slides from a previous presentation. I think we said you might want to share them with your subscriber group.
Yeah, I'll share that with my mastermind. Brendan, there's something, it was a good segue there. You mentioned that people living in Ireland, and a couple of the people that are in my mastermind are actually Irish nationals living abroad. They for whatever reason, some of them are living in other nationalities. Maybe they got a job in the Middle East or something like that. And obviously when they're over in the Middle East earning good money in, we'll say, Dubai or something like that, you're earning good money and you're paying no tax there. But some of them are sort of pooling their resources, and they're saying, I would like to invest back home. Is there a recommended strategy that you would suggest for those kind of people?
Yeah, there is a number of approaches. First of all, from the 1st of July of last year, the Revenue have introduced a new system. Prior to the new system being put in place, there was total confusion by estate agents, by some accountants, and by overseas landlords. Now, the system is now, as you get paid your rent, 20% must be deducted.
Withholding.
And that's, as each rent payment comes in, 20% must be paid over to the revenue. But it's on the gross rent. So you could end up with the tax refund, particularly if you've got a mortgage or other charges. So, but I mean, it is part of the revenue madness at the moment, where for doing the 23 tax returns, we've got 6 months under the old system, another 6 months under the new system. I mean, anyway, they had to do it at some stage. But it is, the essence of it is, you must have a collection agent. A collection agent is somebody who's resident in Ireland and is able to arrange for you to pay over your rents. There is not any way around it. In fact, I spoke to a gentleman who put the whole lot together, a chap called Brian Farrell, who tells me he's a landlord himself in the Revenue. And what he has said, well, I explained to him, I've got a client who's Chinese. She doesn't speak very good English, but guess what? She's got property in Ireland through married, we won't go why. But anyway, so I said, look, she cannot find somebody to act as a collection agent for her. And he said, that's not a problem. She can do it herself. Why doesn't she log on to revenue.ie and solve all our problems? I said, the woman barely speaks English. There isn't a real solution here, you know? And it is a bit of madness, to be honest with you. That particular system, for example, I have another client who's in his late 80s, barely has a phone. His daughter lives in Ireland, doesn't want to get involved. Dad and herself don't get on, can't get a collection agent. So Dad is supposed to log on to revenue.ie. I mean, I've made representations to Revenue and to our professional bodies on this point. But look, the Revenue are very difficult. The situation also applies to limited companies. So if you're a limited company, while all the reliefs with regard to interest and all of that are allowable, but you're still caught with this ongoing continuous payment. One of the nice things about it when it does settle down is that it's almost like a standing order. You can
deduct straight away.
You can you can pay it across. But the obligation is there. If you're an overseas landlord, even if you're losing money, guys, you still have an obligation to file an Irish tax return. So talk to an accountant. Do not ignore this, because you will end up with a whole pile of egg in your face. Like, for example, a lot of Irish, how will I put this, civil servants who are seconded overseas, that's an issue for them, particularly if they're outside the country for more than 6 months. And well,
so they're non-tax resident for income purposes, but because they have Irish property, it must go through the tax
indeed.
system.
So, and the other thing for non-residents to bear in mind is this: if you're non-resident, we've got a number of concepts. We've got residency, which means applies to the year that you're in. Ordinarily resident means applies for 3 years. So the issue for you then is you could leave Ireland this year, but it'd be 4 years effectively before you're outside the Irish tax net. So you could, particularly if you're self-employed outside of Ireland, you can get yourself into a bit of bother because you're still caught for your Irish income. And bear in mind, no matter where you are, who you are, if you've got Irish income, it is subject to Irish tax. You may
regardless of your nationality.
Yeah. Regardless of your nationality. So if you're Spanish or German or Bulgarian or whatever you are, you're still Irish income subject to Irish tax. And if there is a DTA, double taxation agreement, between Ireland and the country you're resident in, you may well get a tax credit for any tax paid. There's unlikely, depending on your income in the country outside of Ireland, you may not get, the personal tax credits.
Right.
But again, it's a wide open field for the revenue. I mean, prior to introducing this system, there were only about 100 companies that were non-resident landlords. It may or may not go up,
Yes.
But we're going to have an interesting development in that. If you follow in English politics, where they were talking about this famous non-dom,
yes, the non-dom
situation, right? They're going to close that, where any of your income, if you're a resident. But do you know something? In Ireland, you may get a lot of English or non people coming into Ireland, because if you're not an Irish national, your domicile is not Irish, you don't get taxed on your worldwide income. You will only get taxed on the amount of the income that you bring into Ireland. So, it's something that may well develop, and there may well be pressure on the Irish government to look at that, But again, just watch this space, it could be something that's coming up for us all.
Brendan, I'm conscious of time. I was just going to ask you a simple question. Like, what would you say is the biggest mistake that you're seeing clients coming to you with for help?
Yeah. Well, there are two of them primarily that I see. Number one is claiming interest when they're not entitled to by failure to register with the RTB. The other mistake is not the capital allowances.
Yeah, not tapping into that benefit.
Not tapping into it. And then a few others that come up from time to time. If you're a sole trader, trying to claim civil service rates for travelling expenses to your various properties, you cannot do that. It's only the actual expense. That's one of the benefits, by the way, of having a limited company, because as a company director, you can claim your travelling expenses.
Yes.
And perhaps another one is, if you and your spouse love each other and all of this wonderful stuff, have it in joint names, because perhaps your spouse may or may not have other income. Let's assume they're at home looking after the children, be it the man or woman. The issue there is, by them having rental income, you can actually earn if you're a two-income family, in 23, you can earn up to 84,000 at the lower tax rate
At the
of
lower.
20%. Think about that.
Yeah.
That'll cover most people, unless they're people like yourself where you're
Don't even go there.
high income earners, But again, 84,000, I think it is, I worked it out. At the lower 20%. Now, there's the PRSI on top of that and USC, but it's still something to bear in mind. So having joint incomes is worthwhile. And it also means losses on one property that he owns and his partner owns, if they own them separately. You can't move the losses between each other, and there are other benefits if they're jointly owned, So they're the sort of thing that comes up. But the capital allowances and the failure to register with the RTB is, even though the RTB, I better not comment in case some of the members of the RTB listen. The reputation is damaged at the moment.
For sure.
We need to just be very careful of what's going on in the Dáil and the housing situation. I've had the privilege of attending the housing committee a number of times. And I must say, I've been very impressed by some of the members there. Mr. O'Brien from Sinn Féin is very sharp. And the amazing thing is, in the housing committee, he has a clear grasp of some of the problems that are caught up for landlords. I'm always amazed, but his public statements are totally different,
Gotcha.
But this the rent pressure zones, God almighty. And what irritates me is you see rents are up 20%, but that's only new properties.
Yes.
And just think about the poor landlords that are stuck in that situation where on the same street, you've got a new property or one that's after the 2-year period, it can get market rate and you can't.
Yeah.
It could be thousands. But the lessons that we must all learn, increase the rent by the 2% every year. And as you and your members are aware, they've extended that.
Yes.
RPZ stuff for further periods, So I don't know. I think really one of the submissions being made to the revenue for the forthcoming budget is to look at something to help landlords. This scheme that they introduced, 600 quid last year, God almighty, it is an absolute joke. But really, they had this capital gains tax thing a number of years ago. If you held onto your property, the holiday, you got tax relief on your CGT. Things like that are well worth looking at again. I mean, it's popular in Germany, I believe, as well, and some of the other countries in the EU. So it's for the government to try and understand landlords are struggling, a lot of them, not all of them, and they need to have policies to help that landlord. I mean, if you're in a situation where your rent cannot cover the mortgage because of the rate increases, I think there were, I can't remember the exact number of interest rate increases, but they were very significant. Yeah. And you could be caught. You're caught in that interregnum. Now, the Minister O'Brien, when I met him, he said, "Oh yeah, I'm aware there's a lot of people stuck in that sort of category and we're trying to do something for them." But I mean, he's constrained to a degree by the Dáil and all the other people that he's got to deal with. But still, as an overall part of the solution of the housing crisis, why are landlords selling? It's uneconomic, and a lot of them are heading towards bankruptcy. And I don't think that should be the intention of any government, to be allowing that to happen. We are part of the solution, and the government need to recognise that and to help landlords in their struggle, either reducing that 2-year thing to, a year or something. anything like that that would help would be really worthwhile.
Yeah, for sure. I'm watching the clock for us, Brendan. I was going to ask you sort of one of the final questions. We have a lot of young people joining my community,
Yeah.
and a lot of them are in their early 20s and very enthusiastic about property, which is great to see.
Mhm.
But obviously, there's a long road ahead for many of them. What advice would you give to those young people starting down this road now?
Right. First of all, do your sums. And if I could just plug my own website, I've got
Do.
a thing called a stress calculator. It's landlord tax returns. Get onto the stress calculator. It's an Excel spreadsheet. Put in the figures and the current rates that you're being offered, nearly double them, and see, can you still manage? You know,
Make your payments.
Do not over borrow. And as soon as possible, get your own mortgage cleared off. Because the trick is you've got to protect your own home first. And then if you do an equity release in your own home, what are you doing to yourself? You're putting yourself in danger.
Yeah.
So try and make.
You're prolonging the mortgage on that home for
Yeah, exactly.
another number
So
of years.
try and get yourself financed outside your own home by savings or whatever other way. And then you've got to think, what are we trying to do? Are we building wealth or are we after income? Because there's different strategies, ways that you need to approach what you're doing. If it's building wealth, there's one way, which we discussed earlier on. If it's income, there's another way. So I would urge them to think very carefully and don't think of, oh yeah, let's buy a property and we'll be millionaires. No, guys, don't work that way. This is a long game. It is not we turn things over, quickly. And just one other, if you're buying and selling houses, by the way, flipping them is the common parlance, you're actually trading, just to bear that in mind. And so you could end up with a 52% tax on that, unless you do it through a limited company. And the revenue look closely at things like that as well. So, but think long term, protect yourself. We've got a saying in accountancy, and I hope it won't offend any of your colleagues there. It's called CYA. And what it means is cover your ass, right? And don't overextension and undercapitalization is a major, major problem. And don't go, as somebody said to me, into a bed and breakfast situation where you've got the full Irish. And if you think about it, the chicken is committed,
yes,
right? But think of what the poor old pig, is totally committed. So don't get yourself overextended is the point that I'm trying to make to you. Just be easy and make sure the thing stands on its own merits. Do not put your home at risk. And the other thing that I find, particularly with partners, is have a partnership agreement.
yes,
even with your spouse, have an arrangement where you both agree what the strategy is, sign it, date it, and make sure it's clear. So in 5 years' time, if it starts to go wrong, saying, I told you not to do this. And you say, well, hang on, we agreed it, okay? Because you can get yourself into a lot of rows by doing that. And if you're going into a company, shareholders agreement. And there's lots of magic you can do if you've got a company, because you could make your children not directors, even if they're under 18, shareholders, and think it's a good way of saving inheritance tax. There's lots of other little things that you can do there, but there is no magic bullet. Even if you're thinking about the inheritance tax, the project that you're in has got to make sense and it's got to work in its own merits.
From day one, yeah.
Come day one. I mean, you're the mastermind that explaining to your affiliates there how to make the thing work from day one. So use a stress calculator. it's
Can
well
you
worthwhile
can
looking
you
at.
remind us your website and how we could get in
Yeah,
contact?
landlordstaxreturns.ie. Now,
Landlordstaxreturns.ie.
taxreturns.ie.
Okay.
Now, just so we're clear with each other, I love talking to people. I'm very happy to talk to your members. I do charge for my time. However, what I give tax advice. I don't do accountancy anymore. So
Gotcha.
I can work with your current accountant or whatever way, or recommend somebody to you depending on where you're located.
So you're a specialist who works with accountants.
That's exactly it. And solicitors as well. And you know, that's the area I've concentrated on. I've done accountancy for too many years, and now it's just tax advice. And that's, for me, it's better because I can see how people are developing their ideas, and I know it's a great sense of satisfaction when you know you've set somebody up in the right direction, and hey, they're a benefit to them, their family, and to the country as well. If people are paying the right amount of tax in the right structure, we're all happy, and ultimately it's the way to go.
That's a great segue to our the end of our call. Brendan,
Yeah.
thanks so much. It's been really, really interesting and super insightful. And I'll share a link to your website in the show notes.
Well, thank you for that, and leave a legacy, guys, behind you. And there is a book, by the way, just pass it on. There's a book called Legacy about the All Blacks, and I'll share on the essence of that I picked up there last year. It's don't be afraid to do the small little bits from cleaning. One of the things I learned from that, I know we're just out of time, but even Richie McCaw, one of the best rugby players in the world, after the match, guess what he has to take turns doing? Cleaning out the dressing room. Nice. So don't be afraid. Don't get so big. You're not afraid to do the small stuff, So there you go. Let's leave it at that, or I'll be talking all night.
That's great. Brendan, thanks so much for your time.
No, I love talking about tax, as I said. So it is. I'll talk to you again if necessary. But thank you again for the invitation. I enjoy, as I said, talking about tax, and there we go.
Thank you for tuning in to another episode of Behind the Facade. If you enjoyed the show or found it in any way useful, could I please ask you to take a moment to leave a review over on iTunes or Spotify. This really helps us get the podcast out in front of more people. If you have any questions or topics you would like me to cover in future episodes, please connect with me via my brand new school community. You will find a link in the show notes. You can stay up to date with all of my content and the projects I'm working on by signing up for my weekly newsletter over on my website, gavinjgallagher.com. That's all for now. See you back here, same time next week.